Hello, everybody, and welcome into Commodity Culture, where we break down commodities markets, sound money principles, and geopolitics, all with the goal of making you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm thrilled to welcome Alasdair Macleod to the program. A 40-year veteran of the finance industry, an expert in precious metals, and the author of the Macleod Finance Substack. Alasdair thinks the recent drawdown in gold and silver was nothing but a blip on the radar, as the continued destruction of purchasing power in fiat currency terms and the rapidly growing credit bubble will send prices for both metals much higher up ahead. Alasdair breaks down where he thinks we are in the credit cycle and when this monster bubble, one that he says is the biggest in history, will finally burst. We also dive into silver shortages at the LBMA, the death of American hegemony, and so much more. So strap yourselves in for my conversation with Alasdair Macleod. Alasdair Macleod, it is great to have you back on Commodity Culture. I want to kick things off, of course, with gold and silver markets facing a fairly steep correction over a couple of trading days. I believe it was last week, Friday, and this week, Monday. We are starting to see somewhat of a recovery at the moment. But obviously, a lot of stackers got spooked by this event. I think we saw such an incredible run in both metals that a short-term correction like this is only natural. So I wonder what your thoughts are. Is this a buy the dip moment? Should some more caution be warranted? Do you think we could see more downside to go from here? What are your thoughts?
Well, whether we see more downside from here, only time will tell. I think stackers. Forget trading. If you want to trade this market, you'll get killed. It's as simple as that. Because they're far cleverer people than you with big, deep pockets who will push things around. And, if they reckon you're in there, they'll kill you. So really, I think you've got to take, if you like, a more sensible view as to actually why it is that you own gold or silver. And the only justification for that, because they are at a premium price, is because they are money. They are legal money. They are final settlement without counterparty, as opposed to credit, which is what a fiat currency is. And if you reckon that the situation for fiat currencies is deteriorating, then that's the reason to hold on to gold. And, whether it sort of goes up 5%, falls 5%, is completely immaterial. The thing to bear in mind is that the value of gold is relatively constant over long periods of time. It is the value of fiat currency which alters, and that has been declining very significantly, particularly since 1971, when the Bretton Woods Agreement was abandoned. So in dollar terms, you had $35, that was the official rate, $35 to the ounce, and we're now looking at nearly 4,150. That tells you basically that a 1971 dollar, or rather the dollar today, is less than 1% in its value of the 1971 dollar. And that's what you've got to keep bearing in mind. It's not a situation that is going to change in favor of fiat currencies. That's for sure. Politically, it would be impossible for any government, in the G7 anyway, to reverse the decline in their currencies. They've been educated, I think, by the macroeconomic establishment, which really started with John Maynard Keynes, to, if you like, use a weak currency to benefit the economy, to stimulate the economy. They're not going to change for that, particularly when freed from the constraints of a gold standard, that they can issue as much debt as they want. And that's what they're doing. So you've got an accumulation of debt, and that's where the crisis now is. What's going to happen to the value of that debt? The other side of that debt is the value of the currency. Debt equals credit. Credit is the currency, and also loans underneath that, which businesses have taken out, individuals have taken out, stock market speculators have taken out. It's the value of that credit, which you've got to question. You've got to keep your eye on that. So, short answer to your question is that stackers should maybe say, well, thank goodness we've got a sort of situation which means I can, save a bit more out of useless credit and put it into real money. Let's hope this pause goes on for some time, and then I can really sort myself out. I think that's the way to look at it, not to be spooked by what's going on, if you like, in up 5%, down 5%, whatever.
Yeah, I think that's a great take, as the fundamentals are all still firmly in place, as you mentioned. A correction is only a natural trajectory of the markets. Things don't go up in a straight line. As gold and silver took a beating, many of the mining stocks, of course, experienced an even deeper drawdown. They are also starting to recover. Many were pointing out that even after the recent rally, gold and silver miners still looked undervalued across the board, especially the big producers, because they were essentially printing cash at these high gold and silver prices. What are your thoughts here on the mining stocks? Do you think we're in a situation where there's a big buying opportunity here?
Well, yes, I would think it is. Now, in terms of timing, that's up to the individuals. But basically, mines are a leveraged bet on the commodities that they produce. And if you see the value of gold expressed in fiat currencies rising, so long as energy prices don't rise more quickly, that's going to be good for mines. I mean, you've got to look at the input cost side as well. And also bear in mind that most producing mines, they will be managed through this. So what that means is that they will extract lower grades while they are profitable rather than the higher grades. So the idea that you can translate immediately a higher gold price into higher profits, I think you've got to temper it a little bit and just understand the reality of it. The other thing I would say is that gold is hardly owned. It's less than 0.5% of all portfolios, if you like. Mines, on the other hand, I think are a bit more owned. And what I'm looking at is this is a credit bubble. Obviously, if you've got a debt bubble, which we have, the other side of that is credit. And more importantly, this credit has been applied to inflating financial assets, particularly stocks. Now, all credit bubbles come to an end. They pop, and when they burst, they usually burst quite spectacularly. 1929, October. 1987, October. October doesn't seem to be a very good month. I'm not saying that this October is going to be the crash, because we'll look back on it and see whether that's true or not. But when the bubble implodes, basically what people do is they will sell anything where they've got a profit in order to cover the things where they've got a loss. So that's the only caveat I would really have, I think, on investing in mines. But other than that, it's you can regard it, if you know what you're doing, as a leveraged bet on the underlying commodity. In the case of gold mines, it could be a way of you catching up if you want to speculate a bit as to, the route to do it. But your core holding always must be the metal, because that is the one thing where there is no counterparty risk.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Absolutely. I think I have some friends ask me sometimes, because they know I do this show, what should I invest in? And I always say you need to have some physical gold and or silver before you even think about investing in any sort of stocks or anything like that. Usually I get a blank stare and the conversation ends at that point. Occasionally I get somebody who kind of gets it. There's been a lot of talk recently of silver shortages at the LBMA, including that at one point they had zero inventory available on hand. Now, there's always a lot of hyperbole that surrounds this topic, so I'm hoping you can shine some light on it for us. As it stands today, What are you aware of when it comes to the situation on silver inventories at the LBMA?
Well, there's no doubt there's been a huge, great squeeze. I mean, you can see this in lease rates, and basically, someone who's got an obligation to deliver physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. The lease rates have shot up. I mean, typically they were sort of up to 30, 40%. And there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. The other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that being over $3 at one stage, which, of course, would prompt arbitrage. I mean, people with silver sitting in COMEX warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA vaults is ETF silver. And the other thing which puts additional pressure on the system is, of course, people look at silver, they see silver going up, they probably think they've missed gold, and therefore the silver is a cheap way in. So they run out and buy ETFs. ETFs have to source the metal. And I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, I mean, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, I mean, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver? So I think it's a situation which actually, particularly through the growth of ETFs, a rising price could lead to further demand and less supply, because the supply always has been from weak holders in the paper markets. So I think Jesse, this is a fascinating situation. It's what they call a Giffen good, something which reverses the normal supply and demand relationships on price.
You mentioned ETFs there. I'm wondering your thoughts on the ETFs that vault physical metal. People always try to make a distinction between the SLV and the PSLV, which is a Sprott product. PSLV buys actual physical silver before they issue shares, so it's supposedly completely backed by physical silver. But I was talking to a bullion dealer named Ian Everard on the show recently, and he pointed out, do you really want to put for example, the PSLV stores their silver in the Royal Canadian Mint. So do you really want your silver under the jurisdiction of the Canadian government? And I mean, the same goes for different governments all around the world. Switzerland used to be the most neutral place, right, where you could store your gold without any worries. Well, now we're seeing Switzerland is no longer a neutral country, so that's shifting. So ultimately, in the worst event imaginable, let's say a global hyperinflation, a bursting of the credit bubble, perhaps a collapse of fiat currencies, are these governments going to potentially seize that metal? Are you going to be able to access it? I wonder what your thoughts are there.
I think what you have to do, when it comes to where you store your metal, and whether it's Canadian Royal Mint or whatever, is to take a view on the property rights of that country. How firm are they? are they likely to be overturned, if you like? Now, I mean, it's an interesting point. I've had arguments with people about what happened in 1933 when, you had the executive order, and basically it wasn't a gold confiscation. People say it was a gold confiscation. No, it wasn't. It was a forced submission, if you like, of your dollars for gold at that time at $20.67 to the ounce. So, if you actually had gold, and it was the banks, basically, if you had it in the banks obeyed the government. So, you lost it. On the other hand, if you had it yourself, then you just kept quiet. But it was really when it goes in the system. And if they turn around and do something like that, then you're going to lose it. The difference today is that you have, in America, there is an official gold exchange rate at $42.22 to the ounce. Now, you have to ask yourself the question, would the Americans force the banks to take your gold and gold under the, in their custody and all the rest of it, and exchange it for $42.22 to the ounce when the market price is 4,100 or even more? I don't know the answer to that question. There may be a legal way in which they could do it. So what I would say is you don't store your gold in America, and you don't store it in a vault owned by an American corporation. And that can be in a vault abroad. So I'd say that. I think the Royal Canadian Mint I would be less worried about, because Canada has some very strong property laws when it comes to property rights. I feel the same in the UK. The same is true in Switzerland. I think the other thing is that there is a big difference between banks who are regulated, and they may well be, I don't know, the regulator, through regulation, if you like, there may be a bit of a danger there. But I think by far the biggest danger with ETFs is that actually, when you own shares or stock in an ETF, it's credit. You do not possess the metal. You do not even have an entitlement to the metal. All you have is an obligation by the manager of the ETF to perform his duties on behalf of you as a shareholder. He's got the obligation, and you've got the credit, if you like, the other side of that obligation. But then it gets more complicated because you don't have a direct relationship, usually, with the manager of an ETF. The manager of the ETF sees as his shareholder either the DTCC or Euroclear, one of those big things. And then it's Euroclear or the DTCC which has the obligation to you. Now, what this means is that in a financial meltdown, when the DTCC or Euroclear or something similar is, if you like, in the middle of failing counterparties, they are perfectly entitled by law to take what you think is yours, shares in an ETF, and deploy it as collateral, or even dispose of them, bearing in mind that it's still got the obligation to you, because it'll just say, oh, don't worry, we've got an obligation to provide it, but meanwhile we're using them, thank you very much. Are you going to be like, do you like that? No, I don't think you would. So bear these things in mind. This is the difference between owning ETFs and actually owning the physical metal, either in your possession or in the possession of, or being stored in a vault, clearly your property, in a jurisdiction with strong property rights.
I want to talk about the credit crisis and the credit bubble we're in, because we've had two automobile-related companies collapse in the U.S., First Brands and Tricolor, causing collateral damage to several financial institutions who are in business with them. In addition, two regional banks, Zions Bancorp and Western Alliance, have come under pressure and seen their share prices plummet as they face loan issues involving fraud allegations. Are these symptoms of the credit crisis we are currently being faced with? And do you think we're going to see, Jamie Dimon, I believe, said when you see one cockroach, you're going to see more of them. Do you think we're going to see more cockroaches emerge here?
Yeah, I think we will. I mean, the fact of the matter is that there was an explosion of borrowing, debt, in other words, when interest rates were suppressed at the time of COVID. You had businesses who were forced to stop trading and needed to finance themselves so they could resume trading once COVID was done. And as well as governments. I mean, you look at governments, the government debt in the US doubled between the end of 2019 and today. I mean, I think it was 23.6 trillion at the end of 2019, which was literally just before the COVID thing started, which I think was 23rd of March or something, 2020. And today we're looking at 47.4 trillion of government debt. So you've got all this debt, and it was all taken out when interest rates were suppressed, when the Fed was going in there doing QE and suppressing yields along the yield curve. So everyone's got all this unproductive debt, and it's basically turned a large portion of the US economy into zombies. And the US government itself, if it couldn't rely on printing money, as it were, is also a zombie. But so I really do think that there's a time factor here. The longer that we have current interest rates, even if they just stabilize them, the longer we have them stabilized, then what you're going to get is businesses falling over. And I think the car loans thing is a classic case, because that's just an agglomeration of debts, everything from good to doubtful to bad. And the idea is, it was the old syndication. Do you remember the property syndication business we had in 2006 to 2008? There are liar loans in there, but who cares? We can slice and dice this so that the top quality, which we'll sell off to the pension funds, will be AAA. It's the same arithmetic, if you like. You just get a huge, great portfolio of all these car loans, and you can give them a rating which actually is far higher than it really deserves. Car loans. I think also the Main Street, as opposed to Wall Street, is not doing at all well. I mean, it really is not. So you're finding that people, they just cannot afford to pay these higher levels of interest, higher debt rates, and all the rest. Higher interest rates. They're not. They're losing their jobs. They're not getting the pay rises. Whatever. I mean, I don't care about job statistics. I mean, they're all wrong anyway. But you can see the underlying economy is actually deteriorating. And even though a lot of government statistics have been shut down because of the debt ceiling, I really do think that there are other indicators which show that the economy is just not good. And under those circumstances, you're going to see more failures. It's quite simple. Eventually, the big failure will be the US government, but that's reflected in a loss of purchasing power for the currency, which is why you have gold. And which is why, when the Fed reduced interest rates a month or two ago, gold took off. And if they reduce it again, gold will take off again. And if they reduce it again, gold will take off again. I mean, because what's the Fed doing? Doesn't care about inflation too much anymore. The priority is to try and keep the economy going, keep the job numbers up.
Well, speaking of which, you wrote recently on X, banks talking about risk in shadow banking don't see the elephant in the room, massive stock market leverage. This bubble will accelerate the decline once the credit bubble pops. Walk us through what you're seeing there when it comes to leverage in the stock market, and how soon could we see this massively leveraged bubble pop?
your last question is the one which I'd like the answer to. But what really catches my eye is the amount of margin debt, which is reported by FINRA. And this basically is debt taken out with the banks, through brokerage firms, but it all comes from banks to finance stock positions. Now, 10, 15 years ago, 10, 12 years ago, that figure was around about between 200 and 300 billion. At the end of September, it was 1.15 trillion. Now, I know nowadays you think a trillion, well, there's so many trillions around, does this really matter? But bear in mind that we're talking about leverage financing. So that 1.15 trillion is probably financing positions at least 3 times that. So, you can just sort of, work out yourself how vulnerable the stock market is. Because the moment that leverage starts going the other way, like the banks saying, come on, we're not going to lend anymore to, the stock situation, then the bubble will pop. I don't know whether it'll pop, it will be sort of, if you like, well, not nice in a nice way, but to see another October smash, because we've had a few in the past. But I mean, this could go on more than you think is reasonable. And yesterday I had lunch in the city with some old friends, and one of them, who's a very, very good technical analyst, said, I own nothing. I have absolutely nothing. The only thing I've got is gold. And he said, this whole thing, I reckon, is going to burst at the end of March. So there's one view, not my view, but I can't contradict it. But when it comes, bear in mind, this is the biggest credit bubble recorded in history, bigger than 1929, bigger than the roaring 20s leading up to the 1929 smash. And bear in mind also that 1929, you had the Smoot-Hawley Tariff Act. And what have we got? We've got top of this huge, huge, huge great bubble. And we've got President Trump running around with his wonderful, beautiful tariffs, which, the combination is likely to do the same sort of damage, but I think on a greater scale.
I want to get your thoughts on the broad market here, because currently the narrative holding it up is that the AI revolution is underway, jump on board or be left behind. However, so far, although AI has been a useful research tool, you can make cool graphics and videos with it, I haven't really seen, at least from my view, it reverberate into the broader economy. There's talks that it's going to replace a bunch of jobs, it's going to increase efficiency by a massive amount. But we're seeing a lot of companies spend so much money on AI. It's a crazy race that's going on right now. And I think there's some concerns out there that the end result will not be as revolutionary as advertised. Is AI really going to change the world in your view, or are AI-related stocks pricing in a fantasy and thus destined to crash down to earth?
I think it is changing the world. I mean, my youngest son uses it in his business. I asked him, did he use it? He said, yeah, all the time. I mean, it saves employing people from his point of view, or alternatively, he can expand the business without having to take on new staff. So there is no doubt it's useful. I think, it's interesting because, I lived through the dot-com bubble, and that's a similar situation in many respects, though I have to say that the dot-com companies were a lot more hot air than the AI companies. But nonetheless, when you get people chasing stocks on a momentum basis, and you get fashions, extreme fashions, such as, investing fashions, such as dot-coms or sussy bubble or tulips or whatever, then beware. It's an indication that we are coming towards the end of a credit bubble. So that's the way I look at it. Now, I think that in many senses, these artificial intelligence operations are better founded, if you like, than the dot-com companies. At the time, there was the speculation there. But I mean, if you think back to before the dot-com bubble, we didn't have emails. We didn't have, I mean, everything is now online, all the rest of it. And the predictions that the companies were making were absolutely right. It's just that, the valuations just sort of ran away before they could actually deliver. AI companies are delivering, but whether they're delivering enough to justify the ratings, of course, is an open question. I think the key thing in all investment is you must keep an eye on the level of credit, how that credit is being applied, and ask yourself, is it being applied at financial assets? If it's being applied at financial assets, so long as that is the case, shares will go up. Or the broad indices will go up. There will be fashions and all the rest of it within that context. But, there comes a time where it gets excessive. And that, of course, is the difficult thing to actually assess. Is the credit which is being angled at financial assets, has this become excessive? And is this a bubble which is going to burst? That is the question you have to ask yourself. But otherwise, the value of stocks depends. Not so much. I mean, obviously, it does depend on whether, an individual company is profitable or not profitable and what the prospects would be. But I think by far the greater influence is the amount of credit made available to investors to invest, and particularly speculators. Hence, the margin situation, whereby that's gone up from, sort of 250 billion to 1.15 trillion. I mean, that is a very serious credit bubble. It really is. But again, these stocks will probably continue to go up until that bursts. But when it bursts, it's going to be not nice. Let's put it that way. Watch the credit. Credit is so important to understand.
I'd love to get your thoughts on the trade war that is currently underway between China and the US, perhaps a symptom of the greater economic conflict between BRICS nations and the collective West. The US obviously hollowed out its manufacturing base decades ago and instead turned to China to dramatically lower costs. It seems like that's coming back to bite them in a way. China talking about restricting rare earth exports, a key input into the military-industrial complex. As I mentioned at the top of the show, I believe that, or I don't know if it was this show that I mentioned it. I've been doing so many interviews recently, but Trump putting that 100% tariff or threatening the 100% tariff on China, backing off after the market crashed briefly or corrected slightly, I guess I should say, something like 2.5%, something like that, which these days is considered, oh my God, the world is ending. Who holds the cards in this trade war, in your view, and how do you see it playing out?
Yeah, it's absolutely fascinating. I'm enjoying watching it. I mean, this is a struggle between the titans. It's Sun Tzu versus the art of the deal. And my money's on the Chinese, personally. I mean, they've got the rare earths thing. I mean, and that really did get Trump backing off very, very quickly. I mean, you put it in terms of the stocks, the stocks fell or whatever. But the main thing was that without those rare earths, America is dead. It's as simple as that. And China has just gone, yeah, that's it. You play that game? Right. Okay. You're not going to get any of our rare earths. Now, Trump is going to go into that meeting. And, I would love to be a fly on the wall because I could just see the Chinese sort of sitting there and saying, well, what have you got to say? And then when he says, well, we'll suspend tariffs for another 90 days. Well, that's all very well, Mr. President, but do we trust you? On your past performance, we find it rather hard to assume that this will be carried through without being varied in some way against our interests. It's going to be fascinating. It really is. I mean, he made a huge, huge mistake doing that. I mean, This is the America. It's typical American shooting from the hip, and thinking everybody will sort of kowtow to them. And the Chinese, they've been around for millennia. They've seen all this stuff before. They still sort of worship, their philosophers of old. So, we're going back to the time of Greek times. Just imagine if we were sort of, thinking in terms of our original philosophies and still looking at, saying, well, we've been around since Confucius. What was it? Confucius was something like 500 BC in our, I think slightly earlier than that. I mean, it's just amazing. I went on holiday to a Greek island. I think it was Xanthos or somewhere, where we were picking up a boat. And there in the street was a statue of Confucius, which was donated by the Chinese government. This is their hero. In Britain we have Winston Churchill or Maggie Thatcher or something. Their hero is literally 2,500 years old. I mean, and they don't change. Okay, you get regimes changing, but their thinking is very much long term, and they've got a lot of wisdom in there. And so it's this long-term wisdom against American brashness. I think someone's going to get their comeuppance.
Do you think that America is losing its status as the global hegemon? Because we're seeing very interesting developments on the geopolitical stage. Obviously, the US looking like they may actually start a hot war with Venezuela is one of the one that comes to mind at the moment. They've been destroying these ships and all crew members aboard claiming they were smuggling drugs. Many people pointing out that's kind of an extrajudicial murder because they haven't produced evidence. And even if they had evidence, this should be, there needs to be some kind of due process before you execute people. There's that. There's the Russia-Ukraine conflict. Now Trump constantly flip-flopping. Now he seems to be firmly on the side of Ukraine, putting new sanctions on Russia, saying they need to agree to a ceasefire. And then, of course, the trade war we just discussed with China, among many other kind of scraps that the U.S. is getting itself involved in, as it has throughout history. But perhaps the difference now is that it's no longer as powerful as it once was. And as you mentioned, shooting from the hip doesn't work anymore. What is your assessment of all of these actions taken by the U.S. administration? Is this a show of strength? Is this them trying to reassert their dominance over the world? How is this a wounded animal lashing out as it dies? What are your thoughts?
Well, of all those, I think I tend towards wounded animal. I mean, on Ukraine, they want out of Ukraine. That's for sure. But the question is, how do you get out of it? And really what he should do is he should do what he's inclined to do, and that is force Zelensky to go and talk to the Russians in order to stop the war. The idea that you have a ceasefire, forget it, because all that happens in a ceasefire is you find that NATO is in there rearming them very, very quietly. And, Putin's not going to put up with that. And the whole thing is, it's actually a failed geopolitical initiative by America. And just as they had to pull out of Afghanistan, they want to pull out of the Ukraine. That's for sure. Leave it to the Europeans is the sort of story. But it's a question quite of how you do that. And I think actually that in terms of relative strength of personality, Putin is coming out of this considerably more informed, more strong, less variable, if you like. That's not quite the right word, but you've got President Flip-Flop on the other side. Last person who comes in, he agrees with. What? So I think actually that in the Asian sphere, I think that there is a greater danger emanating from the relationship between America and Israel. It is clear to me, and I think it's clear to a lot of informed advisors as well, who I would listen to, that the ultimate war in the Middle East is going to be Israel plus America against Iran. I think that's the last throw of the dice as far as America is concerned. If they manage to take Iran, regime change, whatever, then that actually extends their influence to the southern end of all Russia and the western end of China. So they can then start irritating both those nations from that point. So I would think is the sort of strategic thinking which the deep state is considering as a justification for intervening on behalf of Israel in a full-scale war, which will turn out to be a full-scale war against Iran. We hope that doesn't happen, because I think that would be a huge, huge mistake for everybody and could lead to nuclear conflict. I don't think from Russia or China or America necessarily, but Israel I do not trust at all in this. I mean, after all, they're committing a genocide. I mean, let's face it, it's a genocide in Gaza. They would be perfectly prepared to do the same sort of mass destruction of humanity in Iran. Venezuela is interesting. I think that some deep thinkers in the deep state are probably reassessing America's global position. Sensibly, what America should do is it should confine its empire, if you like, its sphere of influence to the Americas, North and South. And I think that that's really what's driving the Venezuela story. Venezuela is seen as a weak spot, which America can destabilize and take, if you like. I think that's that. The next one, I mean, they've also got Argentina, because they've managed to get Argentina, you may remember, was actually offered to become a member of BRICS. But then, Milei got in and, the story changed because they needed the finance to get through his program of reform. And that backing basically came from America and the IMF. So they've got Venezuela, they've got Argentina. Brazil, I think, is the next one. So I think that's probably the way in which America is going to go. But how long it will be before we actually see them more committed to that fallback position, we'll just have to wait and see.
Great analysis, Alasdair, on everything we discussed today, as always. Tell us about the Macleod Finance Substack, what it's all about and where people can find it.
Yeah, well, apart from geopolitics, really I have a mission to try and educate people about what their governments are doing to what they think is money, fiat currencies, which is so important to them, what it's going to do to their wealth, and why they should consider protecting themselves from these evolving situations, as opposed to trying to continue to accumulate more wealth. I mean, the times of accumulation basically are over, and really, it's basic economics. It's credit and money. It's politics, geopolitics in particular. All those factors. MacleodFinance.com will find it.
Great. I'll put a link in the description below. Be sure to check it out. Alasdair, thank you so much for coming on again and sharing your knowledge with the audience.
That's my pleasure, Jesse.
Thank you for joining us today. This episode is brought to you by ARK Silver Gold Osmium. They have some great prices right now. They are up on the screen. All of this while supplies last. If you're interested, be sure to reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arksgo.com, and make sure to tell him that Commodity Culture sent you. And be sure to pick up your Commodity Culture merch. Represent the show in style with a hat, t-shirt, hoodie, or mug, all backed by a 100% quality guarantee. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.